everyone, I'm Ivan Biuki, and welcome back to Wall Street Silver. Our guest today is bullish on energy, agriculture, and precious metals. Please welcome Peter Boockvar. He is with the Weekly Advisor Group. Peter, it's great to see you.
Thanks for having me.
Yeah, it's an absolute pleasure having you on. Peter, the Fed said that they're going to taper soon, and you said in a recent interview, it's time for a reality check. Can you explain that for our audience?
Well, it's time for the reality check for a few different constituencies. One is the Fed. I mean, they're getting mugged by the reality of inflation that they've been underplaying this entire year. There'll be a reality check for markets broadly as the Fed responds to that through tapering and eventual rate hikes at the same time that central banks around the world are doing the same. There's one thing to be bullish when monetary money is flowing everywhere, but there should always be a gut check when monetary policy is about to shift the other way, which we're just on the cusp of.
Peter, you just mentioned, a reality check on CPI, inflation coming up 6.2%. And I take it you don't really even buy that. You think it's a lot higher than that in reality?
Well, 30% of CPI, 40% of the core is housing, with a large chunk of that being the rental component. Right now, rents, if you look at Apartment List National Report for November, are running at a 16% rate year to date, while in the CPI number, rent of a primary residence and owner's equivalent rent are rising at about 3% year over year. So that is drastically sort of underpricing, so to speak, the measurement of inflation in that component, and services being the predominant component of CPI.
If they did have like a real rental number, and I get it, the owner's equivalent rent is all BS. The real inflation number, if they were actually throwing that extra 16-20% of rent in there, and that's 40% of CPI, we'd be already north of 10% right now in real inflation, right?
That is correct.
Yeah.
Peter, if China's growth starts to slow down because their reliance on real estate, will we start seeing stagflation globally?
I think we're already beginning to see signs of it, but it's stagflation is not really, was never a word in the dictionary. It was sort of a word made up in the 70s, where back then it was high unemployment and high inflation. Obviously, we have falling unemployment, but rising inflation. But what we're beginning to see is that rising inflation is going to eventually slow economic activity. And just because consumer spending is a large part of global growth, and consumers at some point will get price sensitive to that, we know that the supply challenges and embedded inflation within that is resulting in auto sales running at recessionary levels. It's resulting in home prices that are rising at a 20% annualized rate, where buyers are beginning to call a timeout and slowing down the pace of transactions. Now, with respect to China specifically, China's transition that they hope to embark on here from an over-reliance on real estate to other things, particularly consumer spending and exports, which they already rely on, that's going to be a bumpy transition, no question. Now, what that means for the rest of the world, I think remains to be seen. Yes, you can say demand for construction materials out of China is probably going to slow. The demand for copper in those buildings is going to slow, but there are other uses now for copper in sort of this new age renewable world that we keep pushing on. So I'm not sure the transition that China is going to make, what it will mean for the rest of us, because on the other hand, over the next 5 years, China is going to see a rise in their middle class from 300 million people to 600 million people. And that's going to create its own demand dynamics. So it's, but I think the bottom line is that the inflationary story that we find ourselves in, the supply problems that we're experiencing, is a global phenomenon.
Mhm.
and it is mud in the gears of business that does slow economic activity.
Yeah, one of the I've heard you say that you think the easy money policies are just pure overkill right now towards the economy, and they probably should have raised rates a long time ago with what's going on. But you think that's probably impossible now for them to raise rates? There's just too much debt, or there's too much, throughout the system.
Well, taking a step back first, right now, when you talk about overkill,
Mhm.
the Fed's idea currently of confronting inflation is to add another almost $500 billion to their balance sheet through June of next year and still have rates at zero.
Yeah.
So, Jay Powell is very easy to blame the supply side, but what's the purpose of monetary policy? It is to stimulate the demand side. It is to stimulate the interest rate sensitive parts of the economy, that being housing and autos. Well, should they still be buying mortgage-backed securities? Should they still have rates at zero and mortgage rates that are coincident with that at historic lows when prices are rising at 20% a year and builders can't even find enough people or enough appliances to finish a project?
Mhm.
That's overkill. There are not enough cars on dealer lots. Should the Fed continuously be pushing cheap money to encourage people to buy cars? That's overkill. So that there's no question that is here. Now, in terms of when they eventually raise interest rates, can we handle it? Well, we saw what happened in the fourth quarter of 2018 when the Fed was shrinking their balance sheet at the same time they were raising interest rates, and it was a 2.5% Fed funds rate that broke the stock market.
Mhm.
Now, it wasn't the end of the world. A 20% decline in the stock market, wasn't like previous bear markets, but it was enough for them to panic.
Yeah.
But we are reaching a point where the Fed's going to have to make a decision, though, is do they rein in all this free money in order to cool the demand side, to better calibrate it with the troubles in the supply side and accept potentially slower growth, but also hopefully with the benefit of lower inflation that will then eventually help growth, but at the risk of hurting the stock market, hurting credit markets, and the excesses that we have in the financial markets, and whether that is in the leveraged loan market now or private equity, which is experiencing the best days they've ever had.
Mhm.
Is the Fed willing to sort of prick that exuberance in order to calm inflation? And they are meeting that important sort of fork in the road.
Yeah, it seems like every cycle of interest raising, the ceiling for how much they can raise the interest rates gets just progressively lower each time. And as you just said, the last time was what, 2.25, and you gotta wonder, but back then we've since then added another 10 trillion in debt to the U.S. government's, about, not counting everyone else, how much debt they've all piled on. It really makes you wonder, what's that new ceiling? Is it like 1%? Is it half of 1% for Fed funds? It's like,
what makes this time sort of different and trying to analyze that and seeing this is that the inflation now we're seeing is something we haven't seen in 40 years.
Mm.
So I like to say that when inflation is low, central banks have a hall pass, and they can go anywhere they want, and they can experiment with anything they want. They can even try negative interest rates. They can try QE.
Mhm.
And that's, of course, what we've seen since late 08 and on. Obviously, the Bank of Japan was doing it before that. But now that you have inflation, I would argue that hall pass is now going to be taken away. And it creates a whole new, different environment. And let's just say we fast forward to next year, QE is done,
Mhm.
which people forget that QE is a $1.44 trillion annualized pace of an increase in their balance sheet.
Mhm.
So turning that to zero is in itself a very big deal in terms of the flow of money. But let's just say we get there and inflation's still running, even if it slows from its current pace of 6 to 7%, let's just say it slows to 3 to 4,
Mhm.
and the Fed starts raising interest rates. Well, what'll happen is, and the crazy thing is that it'll be potentially a sharp decline in the markets that ends up slowing the demand side rather than the interest rates themselves. So a 1% Fed funds rate or 1.5% Fed funds rate wouldn't itself, I don't think, cool down the inflation story enough. You would need something higher than that. But a 1.5% Fed funds rate with no more QE, I doubt that the S&P 500 would still be at 4,700. I doubt that CCC credit spreads would be as tight as they are. And I doubt high yield would be yielding 4% under that scenario. It would probably be a different outcome. So
mortgage rates, you would expect mortgage rates also to go up significantly if the Fed pulls back from their $40 billion a month in mortgage purchases?
Well, it depends, because the trade to put on since 08 is that when QE is on, you actually want to steepen the yield curve. When QE is off, you actually flatten the curve. So it does the opposite of what the Fed intends. The Fed wants to buy long-term bonds to suppress interest rates, but in the previous QEs, long rates actually went up. And when they stopped QE, long rates went down because people maneuvered the curve based on whether the Fed was easing or whether they were tightening, because there's the assumption that with tighten, things are going to slow, let's flatten the curve. So I think this time around, we could get a flatter curve, but still within the context of rates that will still creep higher, and that you can get a higher long end, but that's going to come coincident potentially with a higher short end as the market tries to sort of force the Fed to start raising short-term interest rates. Now, again, trying to figure out how I think the markets will respond more to the rise in short-term interest rates that the Fed starts raising, more so than the economy. But if the markets have a hissy fit on what the Fed is doing, that will then impact the economy.
You think the Fed just rushes back in easy money, or they can't do that now? They're handcuffed to inflation.
Well, that gets to that fork in the road. So let's just say they're driving down this path, and let's just say the S&P 500 is down 25%, and inflation's still running at 3, 4, 5%. Where do they go? Do they make a turn left and try to get that inflation rate down to 2%, their supposed target, but at the risk of further tanking the stock market? Or do they veer towards trying to bail out the stock market at risk of then hurting the dollar, which then further exaggerates the inflation story?
Yeah.
And I do believe, and I don't know when, but I do believe we are headed to that fork in the road, and that decision time that the Fed at some point is going to have to make.
So, President Biden has 3 empty seats on the Fed board right now he gets to fill, plus the Fed chair. He may even have, if he replaces Powell with MMT princess Lael Brainard, then he'll even have her and then 4 empty seats to fill. So let's assume it's now Brainard. We'll just guess because we don't know here today. It's not announced yet. How do you think that Fed would that Fed act any differently than the current Fed?
Well, keep in mind, Brainard has been on the Fed for a while. So current policy, she's endorsed. And from strictly a monetary standpoint, Powell is as dovish as they come. And he's been dovish since he started on the committee pre-financial crisis. He voted for every QE. He voted to keep interest rates at 0 for 7 years. He voted for the slow rate of rate hikes until obviously he accelerated them and when he became chair. But he's as dovish as you can get. So from that perspective, there's not going to be much of a change. The question is on a Brainard tenure, does the Fed become, which they already are creeping towards, the Ministry of Social Justice, and that everything is tilted towards climate policy and inclusion and stuff like that, but with the risk of inflation right now. I think with inflation running the way it is, it's going to sort of narrow their opportunities to expand their mandate, therefore keeping Brainard sort of in check. But she's going to also potentially turn this into a political institution more so than it already is in the eyes of the market, because she made a mistake in 2016 making a donation to Hillary Clinton right in the smack in the middle of an election campaign. And if you're supposed to be an independent institution, what were you thinking when you did that? You may support her, but to outwardly make that support like that, I think was a big mistake. And I think if she's appointed chair, she's going to be a politicized one. And it also means that if she takes over in February 2022 and the Fed is done in QE by June, well, you're only a few months away from the midterms. And now she's going to be perceived as potentially playing political games with rate hikes because she doesn't want to do something before the midterms. So there are problems from that perspective that we could see. Now, from a regulatory perspective, which is why like Elizabeth Warren wants her to be in that seat, well, she can sort of satisfy that focus by just being, the vice chair of supervision, which was Randy Quattrell's job. So that's why I think Powell still gets the job, because he can put her in that regulatory seat while keeping Powell in his spot.
On to the real important question: how does this affect gold and silver? Everything going on, the big picture 2022. Where do you think gold and silver are headed with all this going on?
So gold and silver, we know, had a good 2020, and heading into 2021, thinking that okay, inflation is finally upon us. That's been my, I've been talking about inflation since last year, so I was certainly bulled up for gold and silver going into this year. But I think what we've seen this year is two things. Number one, the market believing that inflation was transitory and believing the Fed in their thought process there. And also thinking that, okay, if it's not, well, the Fed's going to raise interest rates, or I should say, first they're going to taper and eventually raise rates. And why do I want to own gold and silver? So I think that's why they've underperformed this year until, and I think that underperformance certainly picked up steam in the middle of June when Powell said, we're thinking about tapering. And you can see on that chart, that's when gold sold off, when they said, we're thinking about tapering now. Ironically, it was 2 weeks ago today when the Fed finally announced that they're tapering.
That's when gold takes off.
But they kept transitory word in that statement. And the market was reminded that they still believe this is transitory and they're still going to drag their feet with any tightening. And that was the bottom in gold. Just as gold bottomed in December 2015, within days of that first rate hike, because people realized that, they're raising interest rates, but they're going to do it at a snail's pace, which ended up being the case since they didn't raise rates for another year after that. Obviously, again, Powell picked up the pace. But gold topped middle of June, talking about tapering. Gold bottomed that Wednesday 2 weeks ago, when again people realized that the Fed's going to go slow, real rates are going to go further negative, and that this Fed is going to be well behind the curve, almost on purpose. So I do think that the consolidation, the correction we saw in 2021 has now run its course, because now investors have run out of excuses to sell gold and silver. And that the bull market's now about to resume.
Do you have I don't know if you do any sort of targets. Do you have an upside target for gold or silver in mind? Or,
well, I have in my mind. It's not that sort of creative, but can silver go back to its previous highs of 50? Yes. You inflation adjust gold for its 1980 high. You're talking something north of 2,500. And call it an overshoot to 3,000. So is that out of the realm of a possibility? Not at all.
Yeah.
What about $10,000 gold?
So you're not going to give us one of those $10,000 or $20,000 targets? No.
Well, if you replicate the 1970s bull market in gold, in terms of it's $35 to $850, can gold go to 5,000 and just sort of have a rally similar? Yeah, it could. It can go up, bottom to 250 in 1999, and if it went up 20 times that, it would go to 5,000. which is essentially what gold did in the 70s, I guess, yeah, it's possible. Now, anything above that, in this crazy monetary world,
Lots could happen. Yeah, it could get out of
can't
control.
rule it out, but I still have to manage money for clients, and I still have to keep my head straight and narrow. So I'm going to take it one step at a time.
Gotcha. Are you doing any of the mining stocks, or are you more just the physical commodities?
I do mining stocks.
Any names that you're public about that you like to share?
I like some of the bigger ones like Barrick and Agnico, and there's certainly some good smaller ones, no question. But at the end of the day, we have to remember that mining is a tough business. It's really tough getting that stuff out of the ground in a cost efficient way, and the price of your product is not in your control. It's whatever the market tells you on a daily basis. But if gold goes to the prices that we think it can go, and a lot of these businesses are much better run more efficiently and for cash and not for empire building, there's certainly a lot of upside in the miners. But relative to my physical position, my miner position is smaller.
Yeah. What jumps out at me is this chart that Tavi Costa at Crescat put together. Is if gold and silver were the just a sector by themselves, they have some of the highest free cash flow right now relative to inflation that they've ever had.
Yeah, they're cheap. I actually saw Tavi a few weeks ago. The group is certainly inexpensive when you have, for the well-run miners, when you have all-in sustainable costs that call it $1,000 or less, and you're selling your product at 1,800 plus. That's a pretty fat profit margin. I mean, there's no doubt that we heard in a bunch of third quarter earnings reports about the creeping price pressures that they're experiencing, just as everybody else is. But there's enough margin cushion there for these guys to continue to gush cash, improve their balance sheets, pay dividends. And I think in this kind of environment, that's pretty attractive. But I think that investors have gotten burned over many years in the mining industry. I mean, there aren't many industries out there that have destroyed as much capital as the mining business. So I think that's why a lot of people are gun shy. But I do think, again, when this bull market gets going and the money that these miners are going to make, they will get a following again. Yeah,
what I've been struck by this past year or two is how much they're all paying down debt. I own a lot of Kinross. I have owned Barrick in the past, but they're paying down debt. Kinross, for example, just launched a dividend last year. When I first bought it, it was no dividend, and they just launched share buybacks. I mean, it's finally they're doing smart things with their cash. It's like, all right, if our share price is going to be so low, we're going to buy back 5 or 10% of our stock, and these guys are just pushing out so much free cash flow right now. They can afford to do these things, and it's leading to great dividend yields and reduction in share counts. So that's why
I think executives in this business have been very humbled over the past 10 years. And I think that they got their ass handed to them when they got too aggressive in the bull market, and when prices collapsed, they got slapped. And I think that they are entering this period being much more measured. And we're seeing that throughout the commodity space. We're seeing that with energy CEOs, with industrial metal CEOs. Everyone's being very measured. They're not getting too crazy. Yes, you're going to see some M&A activity, but not crazy premiums.
Oh yeah, zero premium mergers have been the thing in gold and silver.
Right, because everyone knows that aggressively overpaying and taking on too much debt is the path to problems. So a lot of lessons have been learned, which means that earnings should be much more powerful in this upcycle than previous ones.
Well, Peter, this has been great. Your first time on our channel, I thought it's been very informative. I would love to have you back in the next 3 months or so next year as the year develops to get your take as things as move. It should be an interesting year next year. Thank you very much.
Yeah, absolutely. Yeah, I appreciate having me on. Thank you so much.
Thank you, Peter.